January. Crazy start to the year, right? Just 3 weeks ago, I made a video titled Prepare for Volatility in 2025, where I mentioned that we should all be cautious and nimble due to the upcoming transfer of power in the United States from Joe Biden to Donald Trump. And from a technical perspective, I expected volatility because we were still inside year, timeframe continuity was red, and candles hadn't uncoupled yet due to it being the first month of the year. Literally days after that video was dropped, stocks began to rally following an inline CPI report of 2.9% on a year-on-year basis, with core CPI up 0.2%, and Trump's announcement of the Stargate project, a $500 billion investment in AI infrastructure. This not only fueled a tech rally, but also allowed stocks to rebound, with the S&P 500 hitting a record high. So everything's good, right? Stock market back at all-time highs, Bitcoin over 100K, that means risk off, right? See, yeah, not so fast. See, while investors were celebrating new highs for the stock market, that same week, a Chinese startup company, DeepSeek, rolled out a free ChatGPT-like assistant that says uses less data at a fraction of the cost. DeepSeek's AI model had more downloads from the App Store than OpenAI's ChatGPT. And DeepSeek claims it only cost them about $6 million to train its AI model, the DeepSeek R1, compared to OpenAI's ChatGPT, which cost about $100 million. Now, this is raising questions about CapEx, or capital expenditure, on AI infrastructure. And according to the Synergy Research Group, in 2024, $282 billion was spent on data centers. And then you got Trump announcing the Stargate project, which intends to invest an additional $500 billion in AI infrastructure over the next 4 years. Why are we spending billions of dollars on infrastructure when the Chinese are doing it at a fraction of the cost? It doesn't make sense, right? This caused a futures market sell-off on Sunday, with global investors dumping tech stocks as they worried that this low-cost Chinese AI model would threaten the dominance of AI leaders like Nvidia. So you can probably guess that Nvidia didn't have a great Monday. It didn't. It plunged 17% on Monday, evaporating almost $600 billion in market valuation, while SMH, an ETF of semiconductor stocks, had its biggest single-day percentage decline since March 2020. But despite this potential threat, investors had doubts about the validity of DeepSeek's data. After all, China hasn't had a great history of being honest with its data. This hopium that this news could be fake led to some relief in stocks following Monday's drop. Unfortunately, that all ended Thursday last week when Trump announced 25% tariffs on Mexico and Canada. So this caused the stock market to fall in the latter half of the day on Thursday, but this panic sell-off was bought up after an average earnings report from Apple and an article from Reuters saying that the Canada and Mexico tariffs wouldn't be implemented until March 1st. But that was all a lie though. See, the next day on Friday, January 31st, Press Secretary Caroline Leavitt refuted the Reuters report and confirmed that 25% tariffs on Mexico and Canada and a 10% tariff on China would actually be implemented on February 1st and not March 1st. So this caused the stock market to slide at the close, with the Dow dropping more than 300 points and the S&P 500 fell 0.5% and the NASDAQ dropped 0.3%. And all three indexes posted their first weekly loss in 3 weeks. Now, this sell-off was felt all over the market, with 75% of stocks in the S&P 500 closing lower. And I posted on my X account last week, welcome to Trump's market. Remember that this is only my opinion and you could take it with a grain of salt, but I believe as long as Trump is president, the stock market is going to be sensitive and data-driven. And we're probably going to continue to see this whipsaw type of price action, and volatility is not over. Now, what does that mean going into February? And as traders, how will we trade in this environment? Now, see, there are two approaches that I'm considering, both dependent on institutional sentiment around the recent news. And the first is a possible rebound in tech stock. See, if this DeepSeek news is fake and the effects of tariffs are either not priced in or we don't see an increase in inflation in later months, these are amazing stocks trading at a discount. See, at the time of this video, you have Nvidia trading at $120, down just a little over 20% from its all-time high. You have Micron Technology trading at $90, Applied Materials trading at $180. You have Adobe trading at $435. Now, just because these stocks are at a discount, are we just going to be jumping into calls? No, of course not. We're going to be waiting for actionable signals to present itself. See, in the first week of February, we're going to be having new weekly, new 2-week, new 4-week, and new monthly candles opening up. So we're going to be waiting for these setups to trigger on these timeframes. Now, my second approach is the possibility of a continued rotation into defense. Now, with all this tariff news and whether or not we're going to see retaliation from other countries, We know that markets are very sensitive right now, and that means that there's a lot of uncertainty. Uncertainty means volatility. So VIX is going to be a ticker that everyone should be paying attention to for this month. And not only because of this volatility, but because we also close as an inside month, actually a 3-1 setup on the month. So VIX has the potential to do a 3-1-2 up or a 3-1-2 down. Now, 3-1-2 down, everything's good. 3-1-2 up though, that's when people need to pay attention to the market, because we know we're going to see a lot more volatility and maybe a decrease in stock prices. Now, if we see more downside, of course, technology is probably going to be a likely short that people are considering. Looking at XLU, the utility sector. If you look at XLU on the weekly time frame, we actually close as a hammer on the week. Yes, we are red on the week, but if we were to trigger a 2-2 reversal back to the upside, we would have a potential gap that we can fill. And if you look at XLU on the 4-week time frame, we close as a 1-3 on the 4-week, possibly setting up for a 1-3-2 up. Now, I know we can also trigger a 1-3-2 down, but we will have those triggers set just in case, and we'll be ready to play both sides, whatever happens with the market. The first ticker on my watch list in the utility sector is going to be NEE. NEE also closed as a 1-3 on the 4-week chart. I believe we are an inside week as well, so possibly setting up for either a 2-1-2 continuation or a 2-1-2 reversal back to the downside. The next ticker that I'm going to be looking at is going to be Duke Energy, DUK. You close as a green hammer on the week and currently full time frame continuity to the upside. If DUK can go 2 up on the weekly chart, you will be triggering a 2-2 reversal on the month. So let's see if they want to continue to bid utilities. We know it's going to be volatile, but we'll play both sides for whichever direction that the market wants to give us. These past 2 weeks, we've seen positive gains in the industrial, healthcare, and consumer staple sectors. And if investors continue to bid these sectors, you want to find actionable signals in tickers XLI, XLV, and XLP, and in stocks with these sectors with similar setups. Now, remember that a rotation into defense could probably mean broader market weakness. And in that case, I'd be looking to get puts in tech, consumer discretionary. Now, what do you think? Do you think these tariffs are going to lead to more downside in the market? Do you think DeepSeek is actually a threat to American AI stocks? Let me know in the comments. If you found this video helpful, make sure to like, comment, and subscribe. Thanks for tuning in. I'll see you in the next video. Keep grinding and keep learning. Peace out.